I'm pleased to welcome you to our webinar today. Good morning to those where it's still quite early, and good afternoon and good evening to those where it's already quite late. We have attendees from all over the world today, and the speakers are domiciled in Barcelona with Fabio Del Bosco, tax partner at Baker Tilly, Spain, with Luc Jacobs and Marijn Verhagen in Amsterdam, Baker Tilly, Netherlands, and Chris Denning in London, international tax partner in the UK. My name is Ines Pausch. I'm a tax partner with Baker Tilly, Germany, domiciled in Munich. Allow me some organizational aspects in advance before we start. This webinar will be recorded and will be sent, the respective link will be sent together with the slides to all attendees after this webinar. Questions can be raised via the Q&A box that you can find below, and we are happy to answer your questions afterwards if there is time enough. Thank you very much to Nahila as well for your great support in the context of this webinar. And now over to Fabio to kick off with the content.
Thank you, Ines. Good day, everyone. And again, welcome to this webinar. It's a real pleasure for us to be sharing with you all this information that we're going to do on the two main developments that are currently affecting the tax community in these days. One of them is the DAC 6, so it's the EU disclosure regime that imposes mandatory reporting of cross-border arrangements. And the other is ATA 2, which is the quite recent amendment of the original anti-tax avoidance directive. Well, it's likely that most of you here today have already had to deal with these developments in your own country and in your own company. And you know that the 1 hour format is somehow challenging to cover all of this. So it's really our intention today is to provide you with a general overview of the impact that these changes have and on the general issues that are associated with them. So the idea really is that you can further familiarize yourselves with these concepts so that it would be not going into too much detail. We've also held some specific webinars in the past month on both international level and national level, which we're going into detail, and we plan to do so in the next couple of months, in October and in November. But you will be duly informed about the next meetings. Also, and something that we want to make clear is that we will also be available to discuss your particular needs or any doubts that you may have in one-to-one sessions later. This will be probably the first week of October, so that you can request one of these meetings at the end of the sessions, and I will explain you how to do that. In the meantime, you will have, as Ines pointed out, the Q&A part of the Zoom, where you can go and append your questions for the moment. So basically, I think without further ado, I think I'll give the microphone and the camera to Luc Jacobs for the DAC 6 overview.
Thank you, Fabio. Happy to go to the next slide. One more, where we have the basics of DAC 6. DAC 6, the meaning of is fairly obvious. It's the 6th version of the Directive on Administrative Cooperation between the EU member states that was adopted in 2018. It's a directive that targets cross-border tax arrangements that meet certain hallmarks, which we'll discuss in a bit more detail in a few minutes. It is actually to help member states combat aggressive tax planning and close tax loopholes by exchanging information about certain aggressive cross-border structures. Who has to report? Those are primarily intermediaries who help design and implement the reportable arrangements. But in case of a legal privilege, or in case there's no EU advisor or an advisor with an EU link involved, the obligation to report shifts on the taxpayer himself. Then the directive provides for a one-off reporting deadline in August 2020 for all arrangements that were reportable and implemented between the 25th of June 2018 and the 30th of June 2020. And then subsequently, there is a 30-day rolling window for each and every new arrangement onwards. However, due to the COVID-19 outbreak, the European Commission allowed member states to make some extensions to these reporting deadlines, which we'll discuss in a bit. And then finally, what information needs to be provided when a transaction is reportable. That is information about the taxpayer, information about the intermediary, details about the relevant hallmark, what type of a transaction are you talking about, a summary of the structure, the date on which the first step of implementation taken place, the value of the arrangement, and the member states that are involved. As mentioned in the previous slides, there was an extension for the deadlines of reporting due to the COVID-19 outbreak, which effectively resulted in different reporting timelines all across Europe, because not all of the European member states adopted this 6-month delay in reporting. For instance, Austria, although they have not adopted the 6 months formally, they have materially adopted some sort of late filing, because they don't have their electronic reporting yet in place, meaning that reporting in Austria only has to take place as from October 31st, 2020. Poland made it even more difficult, adopting the 6-month delay, but giving various deadlines to various parties that have to report, making a distinction between the intermediaries, the beneficiaries, and taxpayers themselves. And then finally, Finland, they were very clear; they didn't adopt any delays and have stuck to the original deadlines. And then one country where, well, the decision is still pending, or at least there is no final decision taken, is Germany, which gives me the opportunity to hand over to Ines, who can surely tell us a bit more about the German situation on DAC 6.
Strange. So frankly spoken, it's really strange what happened and happens at the moment in Germany. Until the 6th of July, everything indicated to the fact that Germany will follow the EU recommendations as well and grant the respective prolongation. However, during a press conference on the 6th of July of the Federal Ministry of Finance, it was, by the way, announced that there won't be any prolongation. And even if professional institutions, representatives of the industry, and similar institutions are currently still trying to obtain a prolongation in line with the EU recommendation, it seems that there won't be a prolongation in Germany at all. So that's quite amazing and strange, but yeah, seems to be fact at the moment. And therefore, I would prefer leaving the topic deadlines and prolongations and continue on the next slide with the DAC 6 examination scheme that can be used as a guideline in all cases. And the first point, just a quick summary of things that you are aware of. The text types that are relevant for the DAC 6 reporting, And therefore we will switch to the next slide where you can see the overview and the differences in countries again. So Nahila, perfect, thank you very much. In most of the countries, income tax, corporate tax, trade tax are covered by DAC 6. Also inheritance tax, gift tax, and real estate transfer tax, as well as the non-harmonized excise duties. Not relevant in principle for the DAC 6 reporting obligations are VAT arrangements, customs issues, harmonized excise duties, and social security contributions. However, there are 2 countries where we have an exception, and therefore the number of EU countries named in the circle is 25, because the additional 2 countries, Poland and Portugal, implemented reporting obligations for national VAT arrangements as well. And this is the second point that you have to look at, and then we can go back to the previous slide and the DAC 6 examination scheme. And if your arrangement fulfills the requirements of a cross-border arrangement, then the next question is to be or not to be. Then you have to decide about the hallmarks. And I hand over to Luc again.
Okay. Thank you, Ines. On the hallmarks, there are two groups distinguished. The first group, for example, structures whereby a standard documentation or a standard structure is used, whereby income is converted into capital or deductible payments are not taxed. The income relating to deductible payments are not taxed or taxed at a low rate. Those type of structures require subsequently a main benefit test, and the main benefit test basically is determining whether a tax advantage is one of the main benefits from the arrangement. If that's the case, then it will be a reportable transaction. If the main benefits test is not met, then there's no reporting obligation. And then on the bottom of our examination scheme, the other hallmarks, examples of those are, for instance, depreciation on the same asset that is recognized in 2 or more countries, or a double tax relief that is claimed in 2 or more countries in respect of the same income. For those type of schemes, no main benefits test has to be applied, and those are automatically reportable structures. And then you end up with the question, who has to report? And as said, that really depends on who is involved, whether there is an EU link, whether that is on the advisor or on the taxpayer. Ines will tell you more about that on the next slide.
Thank you very much, Luc. Well, in the process of reporting, I would like to point out 2 aspects. First of all, the obligation of discretion and what happens in case that there are several intermediaries. First point is the obligation of discretion. I understood that this is mainly an issue in Germany, meaning that the intermediary is not allowed to disclose personal data about the client as long as he is not released from the obligation of discretion. In this case, the intermediary reports only the non-personal data, and the client reports the personal data. As soon as the client releases the intermediary from the obligation of discretion, then the intermediary is allowed to report everything, all data necessary under the DAC 6 obligation. And the second point, very briefly, what happens if you have several intermediaries? The examination scheme helps in this case again. So if you have one intermediary in the EU and all the others outside, then of course the EU domiciled intermediary has to report. if you have several intermediaries domiciled in the EU, usually one intermediary reports, naming the details of all other intermediaries. He receives the registration and disclosure number and can provide them to the other intermediaries so that they can show that all obligations have been fulfilled in case of need. And these are the main points from our perspective in connection with the reporting obligations. And now I want to hand over to Fabio to start the next session about RTAD 2.
Thanks, Ines, and thanks, Luke. Can I remind everyone that you can post your questions on the Q&A side part of the of Zoom that you see at the bottom of your bar for any question that you have on DAX 6 or on the presentation. In any case, as we told you at the beginning, we are going to have some time, probably and hopefully at the end of the session, to answer some of the questions. But I think it's good to roll over and move to RTAD 2 with Marijn Verhagen, another partner as Luke has in Baker Tilly, the Netherlands. And Marijn's presentation will also be followed by a couple of case studies from our colleague Chris Denning from the UK office. Okay, so over to you, Marijn.
Yes, thank you very much, Fabio. Good afternoon. My name is Marijn Verhagen of Baker Tilly in the Netherlands. I'm indeed going to talk about the Anti-Tax Avoidance Directive of the EU that is dealing with hybrid mismatches. The agenda for this part of the webinar will be on this slide. We will start with a brief introduction on this directive. Then I'm going to explain the directive by means of a few examples. And finally, I would like to ask your brief attention for a tool that we developed that may help you in mitigating the risk for your company resulting from the RTAD 2 directive. Well, as I said, a brief introduction on the directive. The RTAD 2 directive is dealing with hybrid mismatches. Hybrid mismatches are a typical tool that is used by companies in an international structure to optimize the effective tax rates. Well, hybrid mismatches can basically be described as elements in a structure, such as entities or financing arrangements that are qualified differently in one country compared to the qualification in the other country. These kind of mismatches can exist due to the differences in local tax systems of different countries. Already in 2015, the OECD issued a report as part of the base erosion and profit shifting project dealing with hybrid mismatches. And basically the conclusion of this report was that the tax consequences of hybrid mismatches should be neutralized to the extent possible, because these kind of mismatches could lead to, well, tax avoidance, tax abuse, which was not desired by the OECD. Well, this has ultimately resulted in the Anti-Tax Avoidance Directive by the EU, and this directive must be implemented by all member states as per January 1, 2020. It's important to realize that this directive does not prevent hybrid mismatches to exist. That's not possible because as long as there are differences between countries' tax systems, there will always be hybrid mismatches. The purpose of this directive is to neutralize the tax consequences of a hybrid mismatch. Well, you can imagine that, well, a hybrid structure is already complex, but anti-abuse legislation to neutralize the tax effects of a hybrid mismatch is even more complex. What I would like to do today is to, well, discuss with you the general mechanics of the Anti-Tax Avoidance Directive by means of a couple of examples. And I will focus in these examples on hybrid financial instruments and hybrid entities. There are different hybrid mismatches. You can think of hybrid PEs, hybrid tax residents, hybrid transfer of assets. But for now, we will focus on the most common ones, which are the hybrid entities and the hybrid financial instruments, because I think those well, we will give you a general overview of the mechanics of the directive, and that will also help you understanding, well, the other elements of the directive if you have to deal with it. Well, a final remark before I go to the examples in more detail is that the examples and the outcome of the examples are currently based on Dutch legislation. But I do expect that, well, all other European countries would have similar legislation because all countries have to implement the rules in a similar way. And the Netherlands was quite strict in applying the directive, in implementing the directive. But a reservation to be made is that you always have to check, of course, the local country implementation rules, because there can, in theory, be small differences. Well, the first example is already on the presentation, and this example is dealing with a hybrid entity. A hybrid entity can basically be described as an entity that is qualified in one country as transparent, which basically means that the entity is not visible for tax purposes. All income is allocated to the partners or the shareholders, while the entity is qualified as non-transparent in the other country. Non-transparent means that you are a regular entity subject to regular tax, a BV or Inc. or a GmbH. In this example, you see a BCO located in a non-EU state, and that is participating in a hybrid entity that is located in an EU state. And we also see an ACO, which is a subsidiary of the hybrid entity. The ACO is making a payment to the hybrid entity. That can, for example, be an interest payment or a royalty payment or a dividend payment. ACO, or the EU state, is considering the hybrid as being a transparent entity. And that basically means, as I said in my introduction, that the entity is deemed not to exist for tax purposes. From an ACO perspective, that means that the payment is actually being made to BCO, at least from a tax perspective. BCO, on the other hand, considers the hybrid as a regular entity, as a non-transparent entity. Well, and this is where the hybrids, where the tax consequence of the hybrids come into place, because from an ACO perspective, you are making a regular interest payment to BCO, which is tax deductible. However, the payment is not subject to tax at the level of the hybrid, because the hybrid is not considered to be a separate taxpayer. Well, from the non-EU state perspective, from BCO perspective, the income is being received by the hybrid entity. So this is a typical situation of a deduction without an inclusion. So without an inclusion of the deducted payment into a taxable base. And this is a typical structure that the ATA 2 directive is trying to attack. Well, the consequence before ATA 2 was applicable was that there would be a deduction at the level of ACO and no inclusion at the level of hybrid or BCO. The consequence of the application of ATA 2 is that ACO is no longer allowed to deduct this payment. And this is based on the fact that there is a payment that is not included in the taxable base due to the qualification of the entity as a hybrid entity. If there would be another reason for this payment not to be subject of the taxable base, for example, if the entity receiving the income is tax exempt, has a general tax exempt status, then the ATA 2 directive does not apply. But in this situation, the reason for the income not being taxed is the hybrid status of the entity receiving the income, and that's why ATA 2 does apply and prevents the deduction. Maybe we can go to the next example, Nela. Again, we are dealing with a hybrid entity. So again, this is an entity that is qualified different in the non-EU states as in the EU states. And in this situation, we do not see a payment to a hybrid entity, but we see a payment from a hybrid entity. In this situation, the hybrid is considered to be transparent from the non-EU state perspective. And the hybrid is considered to be non-transparent, so as a regular entity from the EU state perspective. This basically means that from the EU state perspective, we have a separate taxpayer making a payment to another taxpayer, which is generally tax deductible. However, from the BCO, from the non-EU state perspective, the payment is being made by a transparent entity. And that basically means that the payment is consolidated at the level of BCO. So BCO does not have to recognize separate income. Well, again, we have a situation of deduction at the level of the EU state without inclusion, because BCO is not taxing this income since the income is not visible for tax purposes. Well, this is also being prevented or being solved by the ATA 2 directive. And again, the ATA 2 directive basically prescribes that in this situation, at the level of the hybrid entity within the EU state, you can no longer claim a deduction due to the fact that the income is not being taxed at the level of BCO. In the next example, Nele, can we go to the next example? It's important to realize that the ATA 2 directive does not only apply to payments within group companies. In the previous two examples, we saw payments made by a hybrid entity and payments made to a hybrid entity, but all within a group. In this situation, in this example, we see a payment that is being made outside the group. So that can be a payment to a bank, for example. Again, the payment is being made by the hybrid entity. The hybrid entity is considered in this situation as non-transparent in the EU state. In the non-EU state, well, it is considered to be transparent in the EU state. The transparent status from the BCO perspective basically means that the payment is for tax purposes being allocated to BCO. Same concept as we saw in the previous slides. Without ATA 2, this would mean that both BCO and the hybrid entity could basically deduct the same payment from its taxable base. We call this a double deduction. So it's a bit different compared to the previous concepts where we saw a deduction without an inclusion. In this structure, we see a double deduction of the same payments. This is also an element that is being solved or attacked by the ATA 2 directive. And the solution for this situation would be that BCO, located in the EU, can no longer deduct this payment from its taxable base. This example shows that you do not only have to analyze the payments that you are making within your group, you also have to analyze all payments that are being made outside the group to see whether those payments are deducted at several levels within the group. If that's the case, then there may be an impact of the ATA 2 directive. The final example, which is on the next slide, is not dealing with a hybrid entity, but is dealing with a hybrid financing arrangement. It's a different concept, and it's basically based on the fact that, as you may know, remunerations on debt are generally tax deductible for tax purposes. A remuneration on debt is interest, where remunerations on equity, being dividend, are generally tax exempt for tax purposes. In the past, that meant that if you would be able to have a loan or financing arrangements that has characteristics of both debt and equity, it would be possible to claim a deduction for the interest payment, while the same interest payment was qualified as dividend at the level of the recipient, and there it was exempt. You can, for example, think of a profit participating loan in this respect. Well, this example is dealing with such a situation. In this example, the BCO has provided a profit participating loan to ACO. At the level of ACO, the EU state, the loan is qualified as debt, which basically means that the interest is tax deductible. At the level of BCO, however, the non-EU state, the loan is qualified as equity. And that basically means that the remuneration is qualified as dividend. And dividend qualifies for the participation exemption. So the outcome of this example would be a deduction at the level of ACO and no inclusion in the taxable base at the level of BCO. Well, you can imagine that this is also a situation that is in the scope of the ATA 2 directive. And the consequence of applying the ATA 2 directive in this situation is that at the level of ACO, you do not longer get a tax deduction. Exceptions may be applicable to this general rule, and these exceptions can apply if the income would already be taxable at the level of BCO. For example, if BCO would be in the EU, and if BCO would have implemented the parent subsidiary directive in a right way, then the income would not be exempt, because based on this directive, you do not get an exemption if the same payment is deductible at the level of ACO. So if that's the case, the ATA 2 directive does not have to apply, because there is already a solution for it. But if BCO, as in my example, would be outside the EU, and it has not implemented the parent subsidiary directive, then this situation is basically being solved by the ATA 2 directive. Well, these were the general examples to show, let's say, the general mechanics of the ATA 2 directive. I think the main, let's say, conclusion of those examples is that you really have to carefully look at your group structure, whether there are any hybrid elements in the structure, that they can lead to a double deduction, they can lead to a deduction without an inclusion. Well, as from 2020, in that situation, most likely the ATA 2 would be applicable to your situation, which means that the structure needs to be amended. Before handing over to Chris, who is going to speak about a more detailed practical case study about the ATA 2 rules, I would like to ask your brief attention for the tool that we developed. Nahila, can you go to the next slide? And that's a so-called ATA 2 web application. As you have seen, the rules for the ATA 2 are quite complex. And what we developed is a web application that is basically consisting of a smart questionnaire with questions which can be answered by yes or no. And depending on the answers, the next question will pop up, which basically means that the total number of questions is quite limited. And if you would run this questionnaire, which you can find on the website that is included on this slide, the outcome would be whether you have a high risk or a low risk that ATA 2 may be applicable to your situation. I think this is a very interesting, well, I would say a high-level sanity check to see whether your company or your group of companies can be faced or will be faced with this tax directive. The other interesting element of this ATA 2 web tool is that the outcome is not only a risk assessment, but it also includes a so-called PDF report, including a detailed description why the outcome is low or high. An example of a part of this report is included on the next slide. And this is just a brief example of the report, but it gives you a good insight in, well, how extensive the report is that you get after completing this questionnaire. And this is in particular interesting because the ATA 2 directive, or at least the implementation rules in the Netherlands, also include a documentation requirement. And this documentation requirement basically means that you have to include documentation in your administration why the ATA 2 rules are applicable or not applicable to your company. Well, we believe that if you complete this questionnaire and you have this report, you already made a big step in meeting this documentation requirement. That's another reason why I think this tooling could be interesting for you to use. The tooling is for now based on Dutch legislation, but within Baker Tilly we are looking and analyzing whether it's possible to extend the questionnaire to the other countries as well. As I mentioned in my introduction, most likely all implementation rules in the various countries are more or less similar to the Dutch ones. So it's likely that the questionnaire can be easily amended to other European countries as well. Well, so far, my introduction about the directive. I would like to hand over to Chris now, who is going to speak about a more practical example about how ATA 2 can be applicable in your situation.
Thanks, Marin. So I'm Chris Denning. I'm a tax partner at McIntyre Hudson in the UK. So just I guess a bit of background about the UK's position. So we in the UK we adopted our hybrid mismatch rules in with effect from 1st of January 2017. So we've had them in place for a few years now, and got some live experience in terms of how they're actually applying. And they're based, I think, similar to the Dutch rules. They're based on the OECD's domestic law recommendations in terms of how these rules should be applied in each jurisdiction. But I think in practice, you know, the way they apply is relatively black and white. That there's no de minimis limit in terms of when you fall outside of the rules. And interestingly, considering they're there, and I think in one of the original consultation drafts, I think the OECD were introducing the rules effectively to target hybrid mismatch situations where the resulting mismatch resulted in a lower aggregate tax burden for the parties to the arrangement. What the UK rules don't do, and I suspect it will be the same in other jurisdictions, is they don't look at the overall aggregate tax result for a particular arrangement. You know, our rules very much look at what's happening in the UK, and in my example, which I'll come into a second, I'll show you the actual effect of that, where you can see that the overall effective tax rate isn't impacted in a hybrid situation. So that's just a bit of background about the UK. So if we can go to the next slide, please. So I think one of the most common scenarios, I'm going to talk to this from a UK perspective, but I'm sure in your own jurisdictions you'll have this. One of the most common scenarios where we'll see the hybrid mismatch rules applying is in respect of US groups and in relation to their subsidiaries. As you may or know or be aware of, the US have a regime where they can effectively disregard overseas subsidiaries and treat them as branches. It's called the check the box regime. And I think as a consequence of their recent changes, it's now probably more common for US parents to check the box on overseas entities. But what check the box does is it makes, in the example, it makes a UK subsidiary which is transparent, which is opaque for UK tax purposes. It's a limited company. It makes it transparent when the box is checked from a US perspective. So it's a hybrid entity for the purposes of our rules. And this example is effectively a double deduction mismatch example of the hybrid rules applying. So in this particular case, we've got the UK company not untypically set up, say, as a sales and marketing support company for the US parent selling goods into Europe, or perhaps an R&D fund, or providing an R&D function or some other central function. But the UK company effectively is reimbursed, so it incurs third-party costs and then is reimbursed those costs from the US via an intercompany service fee, most likely on a cost-plus type basis. Now in that situation, because the US has checked the box on the UK, those third-party costs are being deducted both against the service fee income that the UK company is receiving, and because the US ignores the UK for its tax purposes, those third-party costs are being deducted against the US income as well. So there's a double deduction. Now there's a provision within our rules that say if the costs relate to dual inclusion income, so if we'd have had income into the UK from third-party customers, that income would have been included in the UK's return and the US's return, and that would be dual inclusion income. So we'd be okay in that situation. But here we haven't got dual inclusion income. Therefore, on the face of it, there's no deduction for the third-party costs. You know, again, what to all intents and purposes is a transfer pricing fee or transfer pricing charge. So that looks quite odd. Now, the UK revenue woke up to this scenario relatively quickly after the introduction of the rules, and did introduce a leaving provision that effectively reversed the application of the thought of the process of determining what's dual inclusion income. So what the UK rules were amended to say was that if the UK costs relate to US income, so US customer income, then that would be dual inclusion income for the purposes of this particular chapter, and we'd be okay. So by that I mean, if we've got a UK sales and marketing support function, and that activity is generating US sales, you would count that US sales income as dual inclusion income. When that provision was introduced in the UK, I think as commentators and as advisors, we thought that would be relatively widely applied, but the revenue subsequently confirmed that it won't be relatively widely applied, and has to be a direct relationship between the UK costs and the US customer income. So it's not the get out we thought it was going to be. So what does this look like in terms of numbers? So if we can go on to the next slide, please. So the example here is looking at a situation where we've got third-party income coming into the group of 200, third-party costs of 100. We've got a cost plus 10% margin, and UK rate of 19% and the US rate of 21%. So what does that look like in a situation where we've checked the box? So where we've checked the box, so this is where the US effectively disregard the UK. So the US will have income of 200, costs of 100, profit taxed at the US federal rate of 21%, less double tax relief. So if we look at the UK position here, so the UK has got income of 110, which is the cost plus recharge, less the third party costs. So UK has a profit of 10, taxed at 19%. As a 1.9% tax charge or 1.9 tax charge in the example. So that would be double tax relievable from a US tax perspective. So if we go back up to the US, we have the US tax charge of 21, less the UK double tax relief, giving a total US tax of 19.1, plus the UK tax suffered of 1.9, gives a total overall tax rate of 21%, an effective tax rate. Now, if you think back to what I said earlier about the rules being there to effectively counter an overall reduction in the effective tax rate, if we look at what happens when we don't check the box, so this is a situation where the US treat the UK as opaque, as the UK does. So in that example, we can see that the US income would be 200. Its cost now would be 110, which would be the cost plus recharge. So it has a slightly lower profit of 90. Tax rate at 21% gives 18.9%, or an 18.9 tax charge. But there's no double tax relief in this particular case because it's not treated as branch income. So the tax rate is 18.9. UK, same again. It's got income of 110, less costs of 100, giving a profit of 10. 1.9 of tax, total UK tax is 1.9. And if you look at the total tax now, 20.8 in a non-check the box situation, which is what the revenue authorities are pushing companies towards in terms of transparency and everything else. The actual tax, the overall tax rate is lower, the overall tax take is lower compared to a situation where we have checked the box, which does seem odd. And as I say, I think it's reflective of the fact that the legislation, certainly from a domestic perspective, doesn't look at the overall tax outcome for a group. If we go on to the next slide. So taking that example further, where we have a situation where we have where we actually make the hybrid adjustment now. So in the left-hand box now, same example again, but in this case, we're gonna have an adjustment for the hybrid mismatch charge as far as the legislation is concerned. So in the example, we've got the US 200 income, less costs, tax rate of 21. Now, in this case, our double tax rate is going to be much higher because in the UK, we've got income of 110, but because we've got a hybrid mismatch adjustment, we don't get a deduction for the 100. So we have a profit of 100 and 10 in the UK, which is taxed at 19%, giving a tax charge of 20.9. So going back up to the top there, we've got the US tax rate of 21, or tax amount of 21, less the double tax relief of 20.9. So the overall US tax charge is 0.01. The UK tax charge is 20.9. So the overall effective tax rate is the same as the first example. But what's happened here, which probably isn't helpful in the context of UK-US trade negotiations. What's happened here is there's been an effective movement of tax revenues from the US to the UK as a consequence of applying the adjustment, which again, I'm not sure that was necessarily the intention as far as the OECD was concerned in relation to how these rules should apply in practice. Now, clearly, the example there is relevant where the US would get full DTR, full double tax relief, so the US would need to be fully profitable. But you could have a situation in the last example here, in terms of the numbers, where full double tax relief isn't available as far as the US is concerned. And in this situation, you'd end up with quite an extreme situation where the overall effective tax rate, as a consequence of a hybrid adjustment, in an example like this applying, of around 40-odd%, which, as I say, in practice can't be the intention as far as the legislation is concerned. But I think what we're saying is, whilst this is an issue for the UK, I think it would be the same for other territories as well. You know, this is a live current situation that, as I say, we're going to come across on a daily basis in terms of how our US parented clients are structured. So we need to think very, very carefully as to how we deal with it, you know, in the context of looking at the legislation and also coming up with a filing position, you know, and some justification as to why we don't think the rules apply. As I say, in the UK, we've got a relieving provision. I don't know if it's the same in other territories, but that leaving provision isn't going to get us out of a situation, for example, where we've got an R&D function in the UK. I think the revenue would argue that the costs in relation to that function have no or aren't directly related to the costs, or sorry, to the income of a third-party US customer. So it might be harder for us to present that as a filing position. One thing that I've considered doing as a filing position is actually going back to the revenue and saying, well, look, these rules, you know, are there to tackle an overall reduction in the aggregate effective, or the aggregate tax take in a group situation. And I can demonstrate through these examples that in a UK-US situation, there's no overall reduction in tax as a consequence of checking the box. And these are some of the things that we're thinking about in the context of a filing position. So I think what I'm saying is it's, you know, and this is a relatively simple example. Clearly, when you get into more complex examples, the rules are going to be more complex to interpret. And again, just to put that in perspective, in the UK, I think our legislation is about 48 pages. So in support of that, the revenue issued guidance, which is 485 pages, which I think just underlines the complexity of the rules. So that's one practical example. I've got another example on the next slide, which isn't necessarily to talk in detail about the hybrid mismatch rules. I think this is just to highlight the complexity of an international structure in the context of wading through anti-avoidance legislation, etc., that's been introduced both domestically and as a consequence of BEPS. So again, this is from a UK perspective. So this is a structure, not an uncommon structure, with a you know, a contract manufacturer and principal seller, in this case Dutch BV, having transferred its IP to an offshore low taxed jurisdiction in BVI Co, and then selling through local sales and marketing entities in local territories, which have been checked in my example as far as US is concerned. So in this structure, we're immediately into hybridity because we've got checked entities where in this particular case, we have a situation where a royalty is going off to a no or low taxed, probably no tax jurisdiction. So you've got the potential there for, as far as the UK mismatch rules are concerned, of whilst further up the chain, and this is where it gets more complicated because we have issues around and rules around imported mismatches, so we can be second or third in the chain as far as the UK is concerned. So if there's a mismatch further up the chain, we can still end up with a situation where we have to make an adjustment in the UK. So in this example, there could be a scenario where a payment's made from Dutch BV up to IPCO, where there's no income, so it's deduction non-inclusion, as Marion was referring to earlier, talking us through earlier. So that could give rise to a hybrid imported mismatch disallowance in the UK. I guess some other things to think about from a UK perspective is we also have rules now impacting offshore receipts from intangible property, ORIP rules. So again, in this situation, these rules would apply in relation to the sales generated in the UK, the royalty payment that's being made from the Dutch company to the IPCO. Part of that, or that relates partly to the sales made in the UK. So our ORIP rules would try and tax that royalty payment, and the methodology would be to say to IPCO, there needs to be effectively a 20% income tax charge on that royalty receipt. So our rules would have the effect of trying to bring in IPCO into the UK tax net, which again is just something to think about. DAC 6 possibly here, if the IP is transferred from an EU company outside to IPCO in this particular example, diverted profits tax. So I think I just wanted to throw this example in just to really highlight the complexities and the thought processes and the things that need to be considered in relation to existing structures, and also the rules that need to be negotiated when structures are being put in place. So I think that's probably enough from me at this point. So if I can hand you back to Fabio, thanks for listening.
Thank you very much, Chris and Marijn, for the two presentations. As expected, we are going towards the hour, so I think that we have some questions coming through. I don't know whether we'll have time to answer all of them. I think that we have